Hello, everybody. I'm Àlex, CEO and founder of MarsBased. I'll be your host today. In this episode, we talk to Dimitri Steinberg and Brian Flynn from Founder Partners. Founder Partners is a platform for entrepreneurs that want to IPO or sell their business. They are very, very experienced in the art of M&A, but also in creating and growing high growth companies. They are a group of very experienced and seasoned entrepreneurs, former bankers, and investors that help companies that just want to go global with a global mindset, global ambition, with very, very little, if any at all, investment, that want to conquer other markets and they just want to make it big. But they, above all, they want healthy companies. The market has dried up. Now we're facing tailwinds. Not MarsBased, because we are not VC backed, but most VC backed companies, if they didn't reach profitability before 2022, chances are they're in for down rounds, extension rounds, reach rounds, whatever you want to call them rounds, or even down rounds. And some of them might even be in for selling the company. Maybe there's the only way to save something out of a company in distress, right? So if you're here to listen to Dimitri and Brian and learn from them, because these two experienced gentlemen have got over 60 combined years of M&A and entrepreneurship experience, they have got a lot to share. We discuss the incentives of M&A boutiques. We discuss being in both sides of the table. We discuss financial tricks. We discuss when's the right time to approach all of these parties, how to signal or how not to signal certain things, what's the protocol, when to move forward with an LOI, how to drum up interest from other competitors or potential acquirers, and much more. This, I'll let you know right now, this is an episode with a high percentage of wisdom nuggets per minute. This has been one of the most interesting and insightful episodes we have recorded. And I look forward to recording a second part with them because I left out so many questions. And also, we are always asking about the question of the day. And in this case, it will be, what is your favorite M&A story you've ever heard? It can be a funny one. It can be a fuck up. It can be something insightful. It can be something of a big corporate. It doesn't have to apply to you. You don't have to have experienced it firsthand. But if you've heard great stories, just share them in the comment section down below on YouTube. And without further ado, let's enjoy this episode with Brian and Dimitri. Brian, Dimitri, welcome to Life on Mars. Welcome to the show. How are you doing?
Doing great. Thanks for having us.
Ditto. Good to be here.
Well, it's been a while since we last recorded one episode about M&A, and we were talking in the warm-up about how there's going to be a lot of consolidation in the market, right? There was some in 2021, following a crisis, 12 to 18 months after a crisis. There's a lot of consolidation, maybe companies that are not able to raise more funds, maybe some companies run out of cash, maybe they just hired too much or they lost clients and, they run out of business. And one good way to kind of like salvage something out of your business is maybe sell it, maybe not always for a lot of millions, but you can save something out of a business in distress, right? My first question, let's of course we can introduce a little bit founder partners and whoever wants to start, but I want you to explain what are the main reasons for having people with gray hair in the M&A, and you don't want a company that's starting out helping you in this process.
Dimitri, why don't you answer that question since you got more gray hair than I did?
But I'm hiding
Take
it.
off that hat.
So look, I think that one of the most important things to think about, if you are considering hiring an advisor is, what should you be looking for? And there are all kinds of different things that I think are important in that regard. One of those things might be the degree to which your advisor is focused on what you need help with. So some investment banks do all kinds of different things. Other investment banks are exclusively focused on M&A. Other investment banks are even more focused, and they not only focus exclusively on M&A, but they may focus exclusively on sell sides or exclusively working with founder-led companies or technology businesses. We're focused in all of those ways, but that's number one. But the other thing that's, I think, really important is the degree to which your advisor actually has germane, relevant, deep experience. How long have they been an M&A advisor? How many companies have they sold? How many deals have they done in all kinds of different market conditions? And that matters because there's just a tremendous amount of pattern recognition that comes from M&A. And a lot of the times you sort of have to realize that in an M&A process, a tremendous amount of value will either be created or destroyed at a handful of points. What I describe it, what Brian and I describe as sort of critical inflection points. And you sort of don't know ahead of time when they're coming up. And you have to have like a sixth sense about how to deal with them. And that frankly just comes from reps, from having seen it and done it over and over again. And I think that's one of the critical reasons why experience is important. You know it when you see it, and you sort of know how to react in the right way in real time. And that's very, very important in an M&A process, because ultimately you can't take anything back. It's a little bit like, the toothpaste in the toothpaste container, right? You can't put it back in. And so you've got to make sure when you hit those critical inflection points, you make the right moves.
Yeah, I think that's a really good point, Dimitri, or points you've made, Dimitri. One other thing I'd add to it, part of the gray hair, and I'll take, for example, myself and another one of our, is that when you've been on all sides of the table in M&A, you're actually really well positioned. So Dimitri and I have known each other for 30 some odd years. We started our careers together at Morgan Stanley in the M&A department, and then after business school, Dimitri's had this incredible career on Wall Street. I took a different path afterwards, as an entrepreneur. So I've learned how to sell my own businesses, not just be an advisor to other entrepreneurs. But the other thing that I did, and another person on our team has done, is joining on the buy side, basically. I ran corporate development for a public company and bought a bunch of businesses. And I know from having a lot of friends that were also running corporate development in companies out here in Silicon Valley, from Facebook, Google, to lesser known name companies, what's done on the other side. In other words, how a business plan is put together. What are the internal politics of an organization, and how do you navigate that? With all that gray-haired experience on the all sides of the table, I think that that can really help entrepreneurs when they're trying to navigate their own exits and or react to inbounds, for example, so that they understand how a process works. And then that, coupled with what Dimitri just recently said, which is the patterns of different things, it's the patterns of all sides, really helps.
In 1 minute, how would you describe what you guys do at Founder Partners, to give some context to the audience before we segue into the next questions and the whole process?
Sure. Founder Partners is a platform comprised of two types of entrepreneurs, or two types of professionals. We call them builders and deal makers. The builders are folks that have started and sold at least 2 to 6 companies, and they've shifted from becoming an entrepreneur themselves to being a coach. So from player to coach. And the other group of professionals, which is what Dimitri does full time, are the deal makers. These are folks that have been Wall Street. They've gone into corporate development, private equity, and or CFOs, and they're consummate deal makers. And by stitching these two skill sets together, we at Founder Partners are able to cover the full arc of the company build through the exit.
Because one of the things I really wanted you to talk about is this part about the experience, right? We're talking about the gray hair, but it's mostly accumulated wisdom and experience and track record, right? Obviously, you need to have some credentials, some authority, which you bring to the table, because obviously you have created companies. That's something I really respect. That's something I would look for in a partner in an M&A boutique or an advisor in the M&A process if I were to sell my company, right? But the other thing is, like, I see some parallelisms with me being an investor when I have been a founder of a company, right? Other investors might not read between the lines in the reports that we receive, or in the one-to-one meetings we have with the companies. So, like, I'm seeing something. I'm able to read the signals. This company is selling sending to me without actually telling it to me, right? What are the things that you are able to see because you've been a founder yourself, Brian?
A lot of things. It's exactly what you said. Just actually reading in between the lines. Sometimes seeing things that people aren't saying. It's like how people react or what they're not saying. Actually, in selling a business, but oftentimes it's also just asking. I think the right questions. I mean, I think that that's really one of the most important things. If you're a buyer or you're a seller on the buyer side, you got to ask a lot of data points, and you start seeing when founders aren't giving you the right information, how they are responding. In a negotiation, for example, if a seller, you're dealing with a seller of their equity and they're not responding, they may actually have other alternatives. So trying to build a relationship where of true transparency, so you can actually get the data, but don't give up on asking the really important questions. Dimitri, you've got a lot of experience in this, a lot more than me on the M&A front.
Yeah, I mean, look, at the end of the day, it's a little bit like, Sherlock Holmes, the dog that didn't bark. It's not only what people say, it's what they don't say. And as Brian, noted, reading between the lines. And so in an M&A process, and when you're dealing with, potential buyers, you have to understand what they're looking for, and you have to understand how to position the business well.
Yeah, I
Well,
mean, let's talk also. I mean, just other things, other experiences. This goes back to seeing all sides of the table. Entrepreneurs that are out there and they're first or second time entrepreneurs and they're selling their businesses and they don't hear back, for example, from a buyer. That could be another example where the entrepreneur is like, oh my God, they don't like me, or they told me you're going to do this, you're going to do that. But the reality is that there's a whole bunch of other things that go on behind the scenes, right? When I ran corporate development at Macromedia, I had like 25 different companies that we were looking at buying, and those priorities would change a lot. And we didn't necessarily, at that point, have champions there. And when the priorities would change, we weren't necessarily always able to communicate effectively with the sellers. And so the sellers like, oh my goodness, the deal's not going to happen. So there's all sorts of different examples like that. Things that aren't said, don't blame it necessarily on yourself, but there may be other existential threats or other things that are going on in the background. And that's why you want to have somebody who has the gray hair, who's seen those movies over and over again over 30 plus years.
Now, how about like what you're seeing in the last weeks or months? Because I've been seeing a lot of M&A in the consulting or the consultancies sector, right? Because we've been asked, obviously, when there is every 2-3 years we get some requests by big players. There's been a lot of action in the Spanish ecosystem. Some big private equity firms have acquired a bunch of big consulting firms. They're lumping them together to create a macro consulting firm, and then try to sell it to the next one, right? And obviously, what they want is, let's just buy a bunch of them. Oh, how many developers you got? I give you X for each developer you got, and let's just lump them all together. And for me, it's a recipe for failure for their products and their service, but it's probably a good investment for them because private equities don't buy if they don't think they can sell it at a multiplier, right? I'm just in this sector. I've seen consolidation in other markets, in prop tech, perhaps in Spain, a little bit in fintech, but I don't know what you guys seeing in Silicon Valley and the US in general.
Dimitri, you want to take off?
Well, look, I think that what you're describing, sort of the roll-up strategy of private equity firms, has been a strategy that's been employed for, well, I know exactly how long it's been employed, because when I was in a private equity firm 30 years ago, we were one of the first firms out there executing on it. So it's been in existence since the early 1990s. And the thesis behind that is that, there are markets, there are industries that are, number one, highly fragmented, with a lot of sort of so-called mom and pop operators out there, with a highly fragmented group of customers, and that there exists the opportunity to buy up these very small businesses at relatively modest prices, i.e. low multiples of earnings, put them together, extract some level of combination synergies, cost savings, presumably some measure of pricing power, and ultimately exit at a much higher multiple than you came in at, because now you've built a business that might be of interest to institutional investors, the public market, what have you. The challenge, of course, is identifying the right industry in which to do this. And there's some industries that this makes a ton of sense. And there are other industries where you run real risks. And Àlex, you maybe have just described one. I mean, in the consulting industry, these are, body shops. These are people, and you've got to be very, very careful about how you manage them. When your most important assets walk in and out the door every day, it's a very, very different dynamic than if it's a, business with hard assets that you have, a lot greater degree of control over. And so, the strategy itself can make sense, but it's very fact and circumstance specific. And I, can't comment exactly on how likely a consulting firm roll up, how likely that is to be successful, but you're absolutely right to be cautious about it because of the nature of the assets and the nature of the dynamic that comes with that.
How about Brian?
Yeah,
Oh, sorry, I cut you off. Go ahead.
No, I would just add a couple of points here. I think that's really good. I think that sometimes you look at markets that got over bloated, meaning there's too much money that would chase into those markets. Greedy investors, especially in the zero interest rate environment, and this has happened from economic cycle to economic cycle. Let's take ad tech, for example. It was here in the United States, it was a really big deal to have an ad network, right? There are over 300 of them. And then there are all different kind of permutations within advertising technology. So much money chased that thing. And then there are these companies called Google and Facebook that basically dominated and sucked out the oxygen out of that area. And everybody was left to like off of the little morsels. So they were forced, these little companies, to actually consolidate before the music stopped. We're seeing that in marketing tech, lots of types of different companies, and the music will stop. And so I think that kind of plays into don't miss those windows. If you actually are an entrepreneur in some of these markets, know who those partners are that you'd want to essentially marry up with, and do it when you get the timing right. I think in the United States right now, it's a buyer's market, and I believe that's the case in Europe. So it may not necessarily be the best time to be selling, but I'd say no matter what, if you're on the sell side, you're an entrepreneur, have your company always looking good, have profitable unit economics, right? And more buyers that do come around and sniff around are going to be interested in well-run organizations.
All right. Yeah, that was going to be my next question. Let's talk about timing, right? So, Brian, as a founder, that when you build startups, maybe it's not the case with agencies where you're kind of like, because we're bootstrap companies, we tend to be a little bit more organized and clean. We have our house is cleaner just because we don't run out of money, right? And we don't have to rush things. We don't have to take shortcuts. We don't have to cut corners and whatnot. But startups, you run out of money, right? You raise a round, then in 12 months you got to be fundraising again, so on and so forth. And your house isn't exactly very tidy, right? And so if there comes a time around when you have to sell your company, you will never have your data room in the right place. You will never have, you obviously you need to compile all of this data, all these reports, all these KPIs are not exactly up to date, and it takes a while to prepare that. So if there should be a potential buyer for your company, if you don't have all of this information, you're signaling that is your first time, right? So when is the right timing to start compiling this data, to have all of this data prepared, just so you don't signal that they are contacting you for the first time?
Dimitri, why don't you handle that? And then I have some other contextual things that I'd like to come back to around this question, but it's not directly answering it. But Dimitri, maybe you take the first step.
Yeah, so I think that that's a great question. It's easier, it's sort of easier to go along than to sort of do it all at once. So start off being organized and continue to be organized is a great way, right? So, to have a virtual place where you're keeping the critical documents and critical information about your business and keeping that in an organized, accessible kind of format will make your life easier if and when you sort of need to pivot to a sell side. And, back in the day, data rooms were physical, there was a reason that was called a data room. It was a room in which all the data was located. And Brian and I both, as analysts 30 years ago, had the experience of being the data room analyst, sitting in a data room, monitoring it and making sure people didn't come in and steal stuff. Now we have virtual data rooms, and it's a very different world. And now we have all different kinds of alternatives or ways in which you can create virtual data rooms, from, pricey dedicated service providers to sort of homebrewed things like, using Google or Dropbox or Box or whatever to get what you need. But at the end of the day, having a sense of what should be in a data room, sort of the key tabs, if you will, right? Sort of how it breaks down to the basic corporate documents, financial matters, information about IP, material agreements, information about customers, suppliers, what have you. It's good to sort of create a taxonomy of that and start to populate it. And some of the companies that we work with or get engaged with have done a very good job of sort of keeping themselves organized, and it's an easy lift. And in other cases, they need to sort of go back and backfill and create it. But the truth of the matter is, we live in a world today where virtually everything exists in a virtual form somewhere, and with reasonably diligent efforts, can be assembled. I think it's actually not as problematic as it once was, when everything was physical. Nowadays, pulling together a data room shouldn't be too difficult and shouldn't be too time consuming a process.
Yeah, I want to go back to, I think that's great, Dimitri. I'd go back and backfill. I think the most important thing for entrepreneurs to do is to have not necessarily a clean data room, but have a clean business. What I mean by that is
Right
getting
on.
to making sure that you got a great business engine, a profitable business engine, starting at profitable unit economics. And I use the baseball analogy, which is get to first base. First base is to get into sustainable cash flow positive. Because if you're sustainable cash flow positive, you've got an infinite amount of time to do anything, even if you're getting into the markets that are starting to consolidate. You also look better, right? You're in a position of leverage. So that doesn't mean necessarily you don't have to go fill out the data room in advance of getting to sustainable cash flow positive. I get to that first base right away. That's the most important thing. The second thing I'd say is create a situation which I think is even more important than just the data room per se, which is the right partnerships for the company, so that you have optionality through those partnerships. They could be income statement or business development partnerships that you can actually flip to one. So if you get an offer from somebody from outside, you don't have a partnership put in place, you can call one of the partners if you really want to conduct an M&A process. And then the other thing I'd say around a data room is just what kind of data you want to share in an initial conversation. It depends on what kind of conversation you're having. I like to say always have a simple deck about the business, 10 slides or so, right? So there's an overview of the company, maybe a couple of the key metrics, but don't share everything right away. It's kind of a progressive set of discovery. One of the things I see happen a lot, and it's terrible, where entrepreneurs don't know the green, yellow, and red lights of information disclosure at different points in time. So for example, lots of times entrepreneurs will go down to, or go up to Redmond, for example, go to Microsoft, and they'll be so excited because there'll be a conference room filled with like 15 Microsoft folks, mostly product managers and chief software architects. And they'll probe and they'll try and learn as much as they can about an area they want to be in, because they actually are thinking about a build versus buy. The entrepreneur leaves the meeting, feels like it was a great meeting. They don't hear back. And they didn't hear back, but they shared too much information. So I think it's really important that entrepreneurs, don't go down that rabbit hole too many times when they should be focusing on building their business. So kind of understand, don't give the keys to the kingdom of the other side. Just be progressive in what you share. Know the red lights of like, hey, this is too much information I'd be giving at this stage of dating, versus the green light. Hey, I've got kind of that 10-page deck. I'm okay with people knowing roughly, what we're doing in general, right?
I agree with the point of having a sustainable business, profitable one, because it gives you the position of power in negotiation. But then again, then you eliminate 99% of the startups. You eliminate quick commerce, e-scooters, mobility, pretty much all of these sectors that only make sense if you have astronomical units of unit economics, right? But on the other hand, and I don't want to give myself to the confirmation or survivorship bias. I think it's confirmation bias when I look to my portfolio and I see that the best entrepreneurs are the ones who are worst reporters, are the messiest, are they're not tidy, they don't communicate well. And I don't know, then maybe it's because I'm an angel investor and I invest in very early stages of the company. And granted, I'm not involved in the company, it's past Series B, for instance, right? So maybe there's a correlation between that and when's the right time to bring in a CFO. Is that a key moment for a startup that potentially might want to sell? And
Well,
if so, what's the right time to incorporate a CFO into the company?
okay, we'll come back to the CFO. Let's start with like communications and what I've seen over 30 plus years of investing, advising businesses. I'd say the best entrepreneurs are oftentimes the best communicators. Frankly, I've seen the companies where I've personally invested in that have actually done not so well, or the ones that weren't communicating. So like when you're like the entrepreneurs that are communicating, like even if it's a monthly one pager to their angel investors, here's the metrics that we focused on, and here's what we did versus plan. Here's what's working, here's what's not working, and here's where I need the help. And they do this on a regular basis. They're communicating, they're going to be in a good spot. When you have irregular communication, to me, that's highly correlated with something's not going so well within the business, frankly. And back to like CFO stuff, I think it's really start out with a bookkeeper. I think founder CEOs should probably have a bookkeeper if they're not doing the numbers themselves, and that could be part-time and inexpensive. Usually wait until a company gets to a certain size where it makes more sense to have a full-time CFO. And what's that size? I don't know. In our portfolio and companies we look at, it could be 5 million, 10 million or so, and it still may not necessarily be a full-time person.
Okay, because
Yeah, I
then,
think
sorry,
I'm sorry.
cut you off. No,
No,
go
I was
ahead.
just about to say, I think it's almost like a red flag for us if a company has a CFO too early on. It shows a sense of misplaced priorities and perhaps a lack of sort of understanding where resources should be dedicated. And given the powers of automation, about what a CFO needs to do, you really don't, as Brian's point, you really don't need like an actual high-powered, fully dedicated CFO till the business is quite far along, and the money that you'd pay a CFO. And having been the CFO of a startup company, I sort of
That's
say
right.
this from a degree of experience. To a certain extent, I was probably superfluous when I was the CFO of that company, or certainly I could have imagined the company operating without a CFO. And really those resources are probably better allocated towards a more engineering talent, investing in sales and marketing, whatever it is, or simply just banks so the company's got more runway.
So I'm flipping the
Yeah.
question and sending it back to you, Dimitri. Then, what is too early to bring in a CFO?
Well, I think you have to think about what roles does a CFO, or would that particular CFO play in the organization? And when you think about sort of a CFO in a big company, and then sort of think how it maps to like a small company, right? There's sort of a controlling function, the controller function, and then there's sort of the treasury function, right, which is sort of financing and raising capital and things like that. The control function is basically something that can be done by an accountant or somebody of that with that at sort of that level. And on the sort of the treasury function, the truth of the matter is that people who are investing in startups, venture capitalists, angel investors, they don't want to hear from the CFO. They want to hear from the founder and the team that's actually running the business, developing the products, selling the products. The CFO just does not have a lot to add, even in the fundraising of early stage companies. So the CFO, the role a CFO could play in an earlier stage company might be if they're, very strategic and the business sort of would benefit from that sort of seasoned advice. Maybe the founder is, technically brilliant, but lacks other sort of skills or experiences that the CFO can sort of plug organizationally. Maybe the CFO is also effectively the chief operating officer, the chief administrative officer, and is keeping, all of the trains running on time while the founder is really the product visionary. So, your title can be X, but your actual responsibilities, can be far more diverse than that. And that's where I think a CFO can make sense at an earlier stage company where, their roles and responsibilities are much broader than their title might otherwise imply.
How about let's say you engage an M&A boutique because you want to sell your company. Let's get into the real meat and potatoes now. Let's start a process. So you say you want to sell your business. You bring in somebody like you guys, for instance, and you start to get a lot of inbound requests, right? Maybe you got some of them before you engaged the M&A boutique, and it's hard to separate the grain from the chaff. Like we've never wanted to sell the company, but every now and then at MarsBased we receive requests, right? And out of the 10 years we've existed, only 2 of them made sense, and they were our biggest clients, And so in that case, for me, it was easy. I should listen to these ones, but I shouldn't listen to the other ones, right? For me, it was a matter of why are these people wanting to buy me if we don't know each other? I don't know who's on the other side, how they work, what's their company culture, who am I going to be talking to, what do they value in our team? Are they just buying, pounds of developers? And it could be MarsBased as in any other company, or they really want us versus, our biggest clients. Maybe perhaps it was not the biggest offer, but we know each other. We know how they would react, how they treat us. We've got a great relationship. So how do you separate the grain from the chaff when we get too many inbound requests? Like, what would be your advice here? Who want to take this one?
Okay, Dimitri.
So, look, I think you have to be clear whether or not you're just trudging along and you have with no intention to sell your business and you get over the transom unsolicited inbounds versus you hire an advisor or you don't hire an advisor, but you are intentionally running a process and you're now trying to make selections and sort of grade and prioritize the inbound interests and which ones you think are more or less interesting. If it's the former, it goes back to what Brian was saying. You built a great business or you're building a great business and you're really not focused on exiting, and then you're getting these sort of over the transom inbounds. I think, Àlex, you asked exactly the right questions. Why would these parties be interested? Do they make any sense? How does that sort of fit into, my own thinking and aspirations for the business? I'll say the following. When we sort of start from scratch and we think about identifying buyers, and maybe we can use this framework to answer the question you just put forward. Our sort of the way we think about it is almost as if you're a detective trying to solve a crime, and means, motive, opportunity. And I think you can use the same kind of framework when thinking about buyer, right? Motive is the strategic rationale, and that's the most important criteria. But means, right? Does the buyer have the financial wherewithal to actually do the deal? An opportunity, right? Is this the right time? Is the buyer actually motivated to transact? Is the buyer, have their own management team in place, or are they suffering from their own executive turnover? Is the buyer sort of been an active acquirer, or are they someone that's never done a deal before and they have a not invented here syndrome? Is the buyer themselves being subject to being taken over, right? You can apply these criteria to assessing the inbounds and like which one of these parties, checks as many of these boxes as strongly as possible. So that's one thing to think about. The second thing to think about, and I think you were sort of going there, Àlex, right, when you were talking about these were longtime customers or clients of yours, is the importance of building real dialogues, if not relationships, with potential buyers in advance of a potential transaction. That's very, very important. I mean, I like to joke, most people don't get engaged on the first date, right? They need to get to know each other really well. And that's important. That's very important to figuring out whether or not this deal has strategic merit, whether there's a good fit from a culture perspective, whether you as the founder would enjoy potentially working at this company, because undoubtedly they're going to want you to be part of the deal. So developing these relationships with potential buyers and figuring out a way to make these sort of relationships develop organically, or what Brian and I have often characterized as, let's build an income statement relationship before we consider a balance sheet relationship, is a great way to prioritize and assess potential buyers.
I totally agree. Very well said, Dimitri. I just going back to, have in mind what your objectives are, and objectives for different constituents, right? So let's say you're a bootstrapped founder, you have nobody else on the cap table. Everything, the buck stops with you there. Well, I mean, buck stops with any founder, frankly, but you should always know, are you trying to build a $5 million business and exit for, 25 million and then you're done? Or do you have bigger aspirations? Do you want to build something much bigger? Or do you want to have a lifestyle business? I mean, so there's a lot of different, it starts with the objectives of that founder. But then if the founder also has investors or co-founders or, other employees, understand people's incentives and where their motivations are, where they're coming from, so that then you can hit the ground running. You're not reacting to things all the time. You're reacting in a proactive way because you actually already understand those goals and objectives. The other thing I just wanted to bring up is, and Dimitri and I advise founders, like when let's say there's like 3 or 4 different offers and they're all kind of coming in at the same time because a process is being managed. Some of the offers may be with companies that an income statement partnership has been put in place, or there's been a previous inbound. Some of them have been drummed up because, you thought about, oh my goodness, we're selling to the same buyer, the same kind of ICP, and we're strategically adjacent. We have a product line strategically adjacent to this customer or to this other party that's got much bigger means, right? And so you bring, let's say you got 4 parties that are at the table. They're all time. So what's the framework to making the decision? It's not always just pure economics. I mean, you can also hopefully get the economics roughly around the same, but it's actually strategy. That's why Dimitri said it's the most important thing for the buyer, but it's also very important for the seller, because you want to make sure that you're aligned in the same vision. Otherwise, you're not going to probably want to last at that buyer for very long. And last but not actually, probably almost as important, great acquisitions are also when there's great chemistry, right? So you're not going to you're not even going to get engaged if you think that the person or the party is not that pretty and they're not treating you very well, right? So it has to have good chemistry. I mean, those are the 3 things that we like to have founders think through very carefully when they're going through this M&A dating process.
Now, how about the incentives? Because one of the things that I think they are the most complex parts of an M&A process, and having been part of none at all, this is the striking number of 0 in my career. But from the outside, it strikes me as really complicated to understand the motivations and the incentives of the M&A boutique and how to control them, right? So on the one hand, you hire them on a retainer. So therefore, they are incentivized to be with you long enough because they want to maximize a little bit the profit. On the other hand, they don't want you to run out of money, right? So, but understanding that the company is, either profitable or in a good position, they can milk you in a sense. But they also might want to go for the biggest offer because they get a percentage of that, right? So, how do you control these kind of incentives and tell them sometimes you want another acquisitor that is perhaps not the biggest offer? How do you, as a founder, how do you negotiate this? How do you retain control?
If you're talking about the relationships with your advisor and how to sort of optimize and manage them, I think that's where you're going at, Àlex. First of all, first principles, your advisor doesn't decide ultimately whether or not to transact. You as the principal decide whether or not to transact. And you should certainly never, sign up an engagement where you're sort of obliged to pay a fee if you don't do a deal, right? At the end of the day, you want your interests and that of your advisor to be as closely aligned as possible. So I'll tell you from our perspective, the way we think about it and the way we think makes the most sense, given that sort of underlying first principle, is that we assume that our client ultimately wants a successful transaction done, number one, and number two, they want to sell the business for as much as possible. And so the vast majority of our compensation should be tied to that actually happening. That's point one. You also brought up the concept of a retainer, and I think that's actually very, very important. And to give you the perspective of an advisor, the reason we look to get paid a retainer, even if it's a relatively modest one, certainly relatively modest in the context of what the total compensation might look like if we get a successful transaction completed, is it's a little bit of a signaling mechanism, right? I mean, from our perspective, we have limited bandwidth. We can only work on a relative handful of transactions at any given time, and we want to make sure that everybody we're working with is pretty seriously committed to trying to pursue a transaction. And as Warren Buffett has famously said, a check is a commitment and everything else is just a conversation. But I think you also raised sort of another important point, which is how to make sure
That was good.
how to make sure, your advisor isn't milking you, right? That they just, don't drag things on and on. I can assure you that in the vast majority of advisors don't want deals to take forever, right? They want to try to get a deal done and move on. But that's a fair question, which is, what does that mean for me as the principal? Well, first of all, with respect to the retainer itself, our perspective on a retainer is that it shouldn't be, you're better off paying one retainer independent of how long the deal takes to get done. So that as an advisor, as a client, you don't hear the meter running and you're not motivated to terminate the relationship because you don't want to pay the next month's retainer, right? We just pay one retainer and that's for the rest of time. And we're sort of, we're committed to you for as long as it ultimately takes. With respect to what, go ahead, Brian.
No, please go ahead. Sorry, Dimitri.
No, I think, and the final thing you were bringing up, Àlex, which I think is a subtle point, which is, what do I do if I feel like my advisor is somehow trying to get me to do the first deal possible, and maybe not hold out for better terms? And that's, look, that's a fair question to ask, and I think is important. What that really speaks to is the importance of openness and transparency between the advisor and the client, setting expectations for the client to convey their expectations and for the advisor to understand what the client's expectations are in terms of valuation. We've been managed, by clients, and it feels like, they're trying to sort of not be fully transparent with us. And it feels, somewhat analogous to somebody cheating at solitaire. Like, what's the point? The goal here, you're paying us to give you good advice and help you manage a process. We should know exactly what your objectives are. And if your objective is, I don't want to sell this business for anything less than 100, we'll obviously not entertain buyers, and we won't go down a path where we know the bid's going to come in at 50. But if we don't sort of have that openness and transparency, we can waste a lot of cycles, with a buyer that's not serious or is not going to, meet your valuation expectations, and that doesn't do anybody any good.
Yeah, no, I think that's right, Dimitri. I'd also say one of the things that at least I've learned from my days as a banker. I ran a big practice, software and internet M&A practice at a one of the four horsemen back in the mid to late 90s. And how founder partners is very different than those kinds of firms. Two things in particular. Bankers often will bait and switch their clients. And that's really important if you're an entrepreneur. When you're talking to the person who he's got the silver tongue, sounds like his awesome banker, and then quickly you sign the engagement letter, and then you get the B team or the C team. You get the person who's right out of the MBA program. There's never really sold anything before, right? What the heck, right? That's terrible. So bait and switch. You got to hold the feet to the fire of the person you are going to hire. right? And at Founder Partners, which is really cool, is it's WYSIWYG. What you see is what you get. You want the gray-haired person who's been there and done that. You don't want the 25-year-old ex-McKinsey person who's really never done that, or somebody who's trying to become a banker. The second thing I'd say is in learning about banking, it's very transactional. Bankers typically would think to themselves, oftentimes that's why they're terrible investors. Any deal's a good deal as long as it gets done, right? Whereas at Founder Partners, we really care about doing the right deal because we care about karma. We are building a platform, not just an advisory business. So let me give you an example. One of the companies that we sold to Amazon, the founder there was delighted with the process, also learned about the builder side of Founder Partners. And when his golden handcuffs were finishing up as a product manager at Amazon, he wanted to start another business. And he asked about the builder side of our platform. And now he's a portfolio company. This is what we want to have happen. It's not get something done as fast as possible, collect the fee, and next move on. That's not a great way to build something that's really scalable. And I think the Founder Partners are very deliberate about trying to be very different than what's out there.
I totally hear you. I think there's another parallelism in what you guys do and what we do at MarsBased. Of course, I know that M&A advisors or boutiques, they don't want to milk you. Of course, in theory, you want to get the best offer, you want to get the best acquirer and whatnot. But in practice, 95% of the people out there in this business, they're not doing the right thing. The same with development agencies. You always hear horror stories, right? About development agents outsourced to this company and they screwed me over. They never released the code, or like they locked me with these stupid technology and whatnot. And that's precisely why companies like MarsBased exist, right? We live off of these bad practices of other people, right? So I assume it's the same for you. Proof of that is most M&A boutiques or advisors I know and I respect, they're terrible at marketing, right? Why? Because they don't need it. The best companies, advisors, and trustworthy people, they've got these word of mouth recommendations. Like MarsBased, for almost 10 years, we've never had salespeople. We almost exclusively work through recommendation. Why? Because we do a great job. And salespeople are people external to the company, right? So that's that really resonated with me. The other thing is, I really like your concept of what you see, what you get. I'm gonna pay you the royalties every time I use it from now on, because I think that's something that I suffered at Deloitte and the other company I used to work for. Like they were using my CV for potential leads and landing new clients, and then I would never work on these projects. They were sending somebody else, right? It's like every 2 weeks, so Àlex, can you update your resume? Can you update your CV? We need it for we're gonna work for this bank. Or okay, then why I'm never assigned to this project? So I know that they were they were doing that. One thing, like, because we're running out of time, and I think we'll have to record another session. I got so many other questions, the process, but it's been really interesting. So forth. So for me, one of the other difficult parts from the founder perspective, and I always hear that at the people I interview at Startup or on this podcast, is it was really hard for me to conceal this from the team, right? How to keep the focus on the one hand and keep the business running, delegate it to somebody else while the CEO and the C-level gets the deal done. And the second is, when's the right time to communicate and to whom, right? How do you calibrate that?
Yeah. I'll take a stab at that, and Dimitri embellish. So it depends on a lot of things, but let's just take company size, right? I remember at Macromedia when I was running corporate development strategy for the company, and we were selling to Adobe. It was a big deal, public to public deal, $4 billion transaction. And we created a very small team, CFO, CEO, of course, and myself. Nobody else until we got to a signed LOI. And then we had, because that information in a publicly traded marketplace, this would be terrible, be so distracting to, all different kinds of constituents. And as we got closer and closer to a signed definitive purchase agreement, it was only on a need to know basis, right? So tightly controlled. I think even in small companies, I've seen entrepreneurs do it two different ways. Just be open about it. So if the team is really small, yeah, I might as well just be transparent about it. I mean, because why is the CEO kind of leaving with somebody else every kind of odd times when they're supposed to be showing up at meetings? It's just, it creates all sorts of like gossip and questions. So then I think if it's a really small team, the CEO should probably say, "Hey, look, we've had some inbound. We've had inbound in the past, and we're being pretty good. We'll just go explore it. It makes sense, but we're not trying to actively sell the business. You guys have got your jobs to do, and the best thing you could do in helping us is outperform your deliverables, because then we got an even better business, and we'll keep you in the know as to what's happening. But don't get anxious. Don't worry about what your stock options are worth, right? Just do your job, right? I don't know, Dimitri, what's your read on that?
I think everything Brian said is spot on. I think also, honestly, it really is a facts and circumstance, case by case kind of situation. You've got to read the room, right? You've got to know, what is the reality of the situation on the ground. Brian put out, some pretty good, guide rails that, smaller company may make sense to just be open. Conversely, at a much larger company, and he gave an example of a huge company, the importance of keeping the information confidential, particularly given the fact that it was publicly traded. I think that, the kinds of companies we're working with that have anywhere from, let's say, 15 to 30 or 40 employees, that might be sort of the sweet spot of the size of the companies we're working with. More often than not, it's not being shared universally. It's being kept within a relatively small group, whether that's sort of 2 to 3 people, maybe up to 4. And it's for the reasons that Brian described, right? We don't want people distracted from, doing their jobs and focusing on, what's right in front of them. And the other thing that I think is important to recognize is that this M&A process is immensely time consuming. And
Yes.
so you just don't want people sucked into it and then all of a sudden spending, tons of time or, otherwise not, doing their day jobs. And in fact, that's why it's often helpful if you've got a situation where there may be, let's say, a company has 2 founders and one can be, Mr. Inside, keeps the trains running on time and running the business, while somebody else can be Mrs. Outside and actually dealing with the M&A process. We don't always get that luxury of, but if you do, that can often be a great way to make sure that the business continues to operate as it needs to while you're executing and pursuing an M&A transaction. But I'll just, I'll finish by sort of going back to what I said at the beginning. You really need to look at the specific facts and circumstances to decide how broadly to share this information.
Because in the M&A sector, there's a lot of survivorship bias, right? We only hear about the companies that are sold for millions, hundred millions, billions, even, right? But more often than not, most M&A processes, they fail, and they can be a big hit to the morale of the CEOs and C-levels and founders of the companies. How do you bounce back from that? That's a genuine question I've always had. It's like, you're working so hard in a process that can last for 12 months, lots of millions on the table, and then you walk away without anything because somebody fucked up or because the market changed, big technological drop in the stock exchange and whatnot. And what happens, and how do you bounce back from that?
It's brutal. I sometimes think that just having recognizing that this is the risk of M&A, that it may not actually happen, is the very first step. Because if you're reasonable about it, and you have like lower expectations, then you're probably going to be fine. If you have really high expectations, and God forbid you take your whole team thinking that something's going to happen, then it's extreme. It's like being an entrepreneur. Entrepreneurs always, usually young entrepreneurs, have big extremes. Like that's what anxiety and depression can be, such big swings. Same thing in the M&A. But if you actually are a little bit more calculated, more reasonable, that comes with reading a lot, having an advisor. I think that can temper some of those expectations. I actually like to even start out with a client and just say, hey, look, even if we get to a term sheet, for goodness sakes, we got a long ways to go. Dimitri and we wrote, I think, a foundational article about the 10 things that we've learned in 30 years of doing M&A, or 60 some years combined, over 100 transactions. But one of them is, yeah, I mean, even if you get to a signed term sheet, you're probably only 50% of the way there, right? Because there's all these existential threats. Things can blow up, kind of what you were saying. So having reasonable expectations, actually lower expectations, probably helps a lot to manage the anxiety, so you don't get super depressed, so that when the real one comes along, you're actually still going to do this song and dance and do the right thing.
Dimitri, you want to add up something to that, or?
I think everything Brian said was spot on. I mean, fortunately, the very fact that you are a founder means you are likely to be a resilient person who has already gone through hell and back. And so, you talked about survivorship bias. Fortunately, the types of people we're dealing with, have already demonstrated a lot of ability to survive. And I think that's very important. I mean, I've got, two situations that are very apropos here. In one case, the company was sort of a bit of a melting ice cube and was being trampled by one of the 600-pound gorillas. And we couldn't get an M&A deal done in time before the business really started to fall away. And the founder, I mean, he just dug deep. He pivoted. There was a kernel of an opportunity, and he's pivoted to sort of a different product and service, raised some more capital. He's already sort of, got the business back up to, $500,000 run rate. This guy's a survivor, and I am convinced, truly, I am convinced that we're going to have an opportunity to help him sell this reinvented business in the next 24 months. I believe that. In another situation, we had a term sheet in hand, speaking to what Brian just said, and the buyer said, hey, I need to take a break. We need to sort of finish out the year. We have another deal we're closing. We need to take a 3-month break. That's not a pleasant message to hear. It's not a pleasant message to share with your client. But in this case, what made it palatable was our business is healthy. It's growing nicely. It's profitable. And, when these buyers come back in a couple of months' time, our business is going to be more valuable than it was a couple of months ago. And we're not going to cut the price. They're going to be lucky if they get the same price they were talking about a few months ago. So we've got to have that reality and that attitude as well.
I like that. Time for the last question. This is a signature question of the podcast. You guys have to share, each one of you, your biggest fuck up and how expensive it was. And don't give me the usual things. Like everybody tries to give me I hired the wrong person. No, I will not accept that one. Just try to think of a big fuck up that you've had in your career. If related to M&A, of course, all the better. But and if you can quantify in money how much was lost, don't worry. We've had people setting fire to the office.
God, yeah. Okay. This is great. Okay.
You want to go
most expensive fuck up?
I want to go first. I want to talk about things other than M&A. And Dimitri, you focus on the M&A thing because we can cover it. Okay. I'm going to talk about me as my biggest fuck up as an entrepreneur and as an investor. Dimitri, you talk about on the.
Okay. Awesome. I like it. Like your attitude.
So I've started and sold quite a few businesses, and I think I became a little bit too confident, maybe a little too cocky. And I thought that because I was a software guy, I've always been a software and a digital media guy. And so I thought, hey, and I even brought Dimitri in it. I thought I could build a business in the consumer packaged goods space, and it was called New York Tapped, which was basically bottling New York City tap water. And I was pumped. I thought it was a brilliant idea. We were on the David Letterman show. We were all this free PR that came around, and I was like, yeah, this is going to be a cool business. And it went bankrupt. I lost Dimitri's 25 grand as angel investment, and it was just like, God. But that was a screw up. And by the way, I've had others. I mean, I've been a serial entrepreneur. I've had some other failures besides all the things that look glamorous and good on the outside. But what I learned, it's actually the screw ups are about learning, frankly, right? And so I learned I better stick to my knitting. My knitting is software. Just don't go outside of that. Don't look for me to do anything in biotech or semiconductors. Just stay to software.
Àlex,
But how much money?
Àlex,
Yeah.
Àlex, have you ever seen a $25,000 bottle of water?
Thank you for rubbing it in my goddamn face, Dimitri. I love you.
Love it.
No,
I knew you were going to go for that. Yeah. How much money was lost in the?
Well, it's not so much it was about the money, because I'm going to get to the money thing in a
Okay. Yeah.
second. I mean, a big number.
You're not getting out of this without revealing the numbers.
It was ego, bruising, embarrassment, and time. And time is definitely valuable, right? Come on, when you're like really humping it on a company. Here's an expensive one. I think, and I ran the math on it. I made a $200 million mistake.
Jesus Christ! All right, I want to hear that.
It's a big one.
Directly to the top 5 of this podcast.
Okay.
Only top 5?
Only top 5. Yeah. Oh, we've got some really big ones.
200 million?
I mean,
200.
Yeah.
But here's the problem is I made another one too, was about $100 million. They kind of fell into 2 categories. Actually, the same category, missed out investment opportunity, right? I mean, you've heard this before. Those are the biggest mistakes. I did not invest in Roblox, and I should have when I had the opportunity. And my co-founder at Founder Partners is on the board of Roblox, gave me the opportunity. I said, "What is this? It's a gaming. It's a game. I'm not in a game." I didn't realize it was going to become a platform. And boy, oh boy, that was crazy. But you know what though? Because I'm so positive, and I try and see the positives and all the negative stuff. The positive side is, if I had made that, I don't know if we would have built Founder Partners. And to me, that's my true love. I'd pay millions of dollars, even if I had 200 million, to actually do what we're doing at Founder Partners. It's really fun.
I don't know. I don't know if you guys have got a hard stop in 2 minutes, but I don't. Just Dimitri. So I don't know if you got time constrained or you got only 2 minutes to share your M&A fuck up. For me, you can go on.
I need to leave in a couple of minutes, but Dimitri, keep going.
So before I joined up with Brian, and I was sort of more of a traditional M&A banker, I was working on a deal, and it's at a boutique. So I mean, it was very much like the fees we'd earn, much of it would go into our pockets, and this was a $750, $800 million deal. We had a $9 million fee and tied up with it, and we had fully negotiated everything. And on a Saturday, we had like 5 outstanding items. We had top tier law firms, and there were 5 outstanding items still left to resolve. And then the seller just went radio silent on us. And I remember going from sort of quizzical to somewhat concerned to very concerned to getting an email from the advisor to the seller saying, "Can you speak tomorrow morning on Sunday at 7:30 in the morning?" And having this sort of pit in the bottom of my stomach form, getting on this call and being told by the sellers, "Oh, we just sold this business to someone else. The deal is done and dusted." First time I had heard that term, and never forget it, since it was in the context of losing a $9 million M&A fee. And you sort of go back and you Monday morning quarterback, what did I do wrong? How did we miss out on this? They used us as a stalking horse. They basically brought our offer to the other buyer. And at the end of the day, we did not insist on a period of exclusivity, and we should have done that. We didn't do it because it was a competitive M&A process, but we should have just put our foot down at that point and said, if you want to talk to us, we need 48, 72, 96-hour period of exclusivity. It doesn't have to be very long. And I think we were just so excited, and we thought we were in the driver's seat. I think we had a little bit of that hubris that Brian was talking about. And we let that thing slip away. And disappointed client, and needless to say, seeing a $9 million M&A fee go up in smoke in the period of 24 hours was very, very painful.
Gentlemen, thank you for opening up. This makes this episode even better. This is the icing on the cake of a really, really, really special episode. So thank you very much for being part of this podcast.
Thank you for having us.